This learning object is designed to help you learn how to build your credit score. Click the Start button to begin. Before we begin our module, let's see how much you already know about building credit. Select the type of loan that is most useful for building a good credit score. If you don't know, just make your best guess. There are many myths out there about what credit scores are and how they work. The good news is that they're not as complicated as you might think. While there are many types of credit scores out there, there is only one type of score that is used almost universally throughout the United States. FICO, which stands for Fair Isaac Corporation, is the company that calculates this score. It is called a FICO score. This is the score used in about 95% of all professional credit score checks. Any other score that you may get on a bank statement or from a website is just a guess and can be misleading. FICO gets its information from the three major credit bureaus that collect and share your borrowing history. These companies are Experian, Equifax, and TransUnion. With the FICO score, the higher your score the better, and those with less than perfect scores will pay an increasing amount of money for things like loans and auto insurance premiums. Roll over each score range to see how much extra each score might cost you compared to a perfect score. There are 5 factors that make up your FICO score. Each of these factors affects your score in some way. We'll talk more about these 5 factors later on, but feel free to roll over each factor with your mouse for a brief summary of how each contributes to an overall score. Now, this is the point where some people might say, why bother with the credit score at all? I don't plan on borrowing money, so why should I even worry about it? These are excellent questions because it is very wise to avoid borrowing and going into debt. However, using that as an excuse to not build your credit can be a very costly mistake, especially considering that you don't actually have to go into debt to build a score if you do it correctly. The most important thing to remember is that in the world today, credit scores are used for much, much more than just borrowing. In addition to loans, your credit score can be used to determine your eligibility and costs for apartment rentals, home, auto, and life insurance policies, utility services such as cell phones, elective medical services, private schools, and last but not least, employment and promotion with a growing number of employers. My name is Luke Erickson, and I'm a personal finance educator with University of Idaho Extension. In this module, I'll discuss the 3 loan options available for building credit, the pros and cons to each, and we'll take the guesswork out of building your credit score. The 3 main types of loans are finance company loans, installment loans, and also revolving loans. Now beware, because not all loans are created equal. Some are harder to get as a first loan, and some do not build your credit as effectively as others. So let's pretend that you are about to choose your first loan. Which do you think will help you build your credit the fastest? For examples of each loan type, simply roll your mouse over the words. Now when you're ready to, go ahead and click on one of the loan types and we'll learn a little bit more about how it will affect your credit score. You chose to look at finance company loans. Let's take a look at what a finance company loan would do for your credit. First, finance company loans are extremely easy to come by, even without any credit history. That's the key marketing point for payday lenders, check cashers, rent-to-own shops, and the like. No credit, no problem. Unfortunately, all this quick and easy money comes with a catch. First, these loans are considered high-risk loans and are extremely expensive. Costs of payday loans average about 600% APR. That means that the cost to borrow $500 over a year's time is, get ready, $3,500. Yikes. That's 7 times the original amount borrowed. This is what we call in the financial world a really crummy deal. And if you think the bad news ends there, think again. Aside from the outrageous upfront costs of a finance company loan, these loans also cost you because of their effect on your credit score. Finance companies will not help you build positive credit history. In fact, they will only build negative credit history, and here's why. Remember the 5 factors that make up your credit score? This is how a finance company loan affects each factor. First, simply having a finance company loan is automatically considered to be a negative thing in the types of credit used section of your credit score. This is because finance company loans are considered high-risk loans. In other words, when choosing this type of loan, you're basically saying that you consider yourself to be a high credit risk. Whether you truly are or not does not matter. The moment you open a finance company loan, you have placed a negative piece of information on your report for at least 7 years. This is because all loan information stays on your report for 7 years from the date of last activity. That's worse than breaking a mirror. And talk about bad luck. And our bad luck doesn't end there. Most finance company loans have very short payoff periods, usually 2 weeks or so. So there is a tendency for users to users of these loans to continue to pay off rapidly closing accounts and open new accounts in order to carry a loan balance for long periods of time. New credit, which makes up 10% of your score, is negatively affected every time you open a new account. All this opening and closing of accounts significantly hurts the new credit section of your credit report. Also, the 15% of your score, which measures length of credit history, takes a hit with each of these new loans because it significantly outweighs any mature or old accounts that you may have in your history. The amounts owed factor is 30% of your score. This reflects the loan balance to loan limit ratio, which is just a fancy way of saying that your current balance is compared to the beginning or maximum possible balance on that loan. Because finance company loans have very short activity periods before they're closed and have costly interest rates and fees, they almost always show very high debt ratios, which can significantly hurt this portion of your credit score. And finally, payment history, which makes up 35% of your score, simply indicates whether or not you make your payments on time. Simply getting a finance company loan does not automatically damage this factor of your score as it often does with the other 4 factors that we already talked about. But because many customers often misunderstand or underestimate the cost of these loans, their short payment periods, missed payments are much more common with these types of loans than with others. It only takes 2 or 3 missed payments to significantly drop your credit score. So there you go. In a nutshell, finance company loans can be automatically negative for 4 factors of your score with a very high likelihood of negative activity on the 5th factor. That means that finance company loans are never a good place to start building credit. In fact, it's probably best to stay away from these types of loans altogether. They are expensive and have very little capacity to positively impact your score, yet they have a high capacity to significantly drop your score. Finance company loans turn out to be a bad deal for you and your credit. So let's take a look at different types of loan options as a possible way to build your credit. The best examples of installment loans are auto loans, student loans, home loans, and personal loans. With installment loans, you borrow a large amount of money up front, then agree to make fixed monthly payments over a specific period of time in order to fully pay off the loan. For example, an auto loan of $15,000 at a 7% interest rate would require monthly payments of $300 for 5 years to completely satisfy the loan. Using the example of a $15,000 auto loan, let's see what a typical installment loan might do for your credit. First, an installment loan is considered to be a good type of loan and contributes to the 10% of your score that measures types of credit used. Ideally, you would have both a mix of revolving and installment loans to get the highest possible benefit from this credit score factor.